Are you sure you're getting the most out of your infinite banking policy, or are you using it all wrong? In this video, we're going to explore the top ways I see infinite banking being misused and abused, from treating it as a checking account to falling into the trap of high fees. So stay here because I got 5 things that you need to avoid and start making real money in your policy today. All right, so number one of the mistakes I see people making all the time, and they learn this from infinite bankers, especially those that want to make a higher commission off of them, is they'll convince them to use it as a checking account. They'll say, listen, run all of your expenses through this, run all of your money through this, and then you pay all your bills and you'll make an extra 20 bucks of interest a year, right? They'll try to convince them. Now they won't say 20 bucks of interest a year, or you'd never be like, yeah, and? But that's kind of the truth, right? Let's just make it as complex as possible. Let's make it as hard for you to use as possible. And ultimately, really, you might make a few bucks extra a year, but that's it. Not worth the part-time job, in my personal opinion. I know that some people like that, but trying to use an infinite banking policy, moving the money in and out is really just kind of inconvenient. It's much more convenient when we're in a society of debit cards and credit cards and stuff, and you just even tap and get things to work. That just doesn't really exist with life insurance, right? You have to jump through more hoops to do it. And the truth is, really, when you see the insurance agents, whenever I try to look at it, analyze it for myself to see if it's something I actually want to use, I really just see it as a ploy for them to be able to do a bigger policy on you so that they make more commissions off of you. It's really not a great strategy to use, and so I would just recommend not using it like that. Now, I'm not saying you don't use it for certain things, but don't use it as something where you're just constantly paying bills out of it or trying to pay yourself once a month and that kind of stuff. Is just really not worth it. It's better really just to use if you're gonna do these one-time type things like investments and things like that. Another way I see people doing it incorrectly is they want to put these huge down payments on things, right? Now, what I mean by huge down payment is that they want to do a policy where they dump in a bunch of money up front. So like for example, I knew a guy that was a real estate investor, and an insurance agent talked to him and says, yes, you want to put in $750,000 in year one, and then after that, you'll put in about $250,000 a year. And so he asked me, he sent me the numbers. He said, Chris, what do you think of this? And I looked at it and I said, okay, you could do that. And I even showed him apples to apples. The crazy thing is, I showed him apples to apples, and mine still in that first year had $100,000 more than the other guy's policy. But I just said, well, like even though mine still beats it, and that's great, honestly, from an investor perspective, I would not do that big of a down payment. He said, why not? I said, well, for you to do that big down payment, they have to raise up the cost of the policy. The death benefit has to go much higher, which costs you more money, which just takes more money out of your pocket. Now it pays, because there's more cost in the beginning, it pays the insurance agent 3 times as much. So I'm like, I wouldn't go that route. I would actually design it more like this. And so now instead, he's actually not doing that. He's actually putting in about $300,000 a year, just steadily, instead of dumping in that extra $450,000 in year one. And what happens is he gets a much better rate of return on his policy. So again, those big like lump sum down payments, it sounds awesome because people are like, oh, it's like a checking account. But understand that first year that you put money in is the most expensive year on whole life insurance. So unlike term insurance where it's just always everything goes to cost, right? And it gets more expensive over time, whole life gets cheaper over time. But the most expensive year is really in the first year or two. And then about year 3 onward, it gets drastically cheaper. So the worst thing you could do is put the bulk of your money in year 1, right? When at least in that guy's case, it was like over a third of that money, almost a half of that money came out to go to insurance costs. And guess who those insurance costs? Guess who gets paid a percentage of that? The insurance agent. So when people ask me, like, how much money do you make on this? I just say, well, pretty much whatever the fees are, I make a percentage of that. So whatever you don't make in cash that first year, that's what I make as a percentage. So it's very simple to figure out, but don't just do a big dumping of money. Now, another mistake I see people doing is that they'll borrow money to pay the premiums. They'll say, hey, Chris, I just got this brilliant idea. I heard another infinite banking guy talk about this. But what I'm gonna do is I'm gonna borrow from my home equity line of credit, and I'm gonna pay into my policy and then use that money to invest, and then that money will pay into my policy to then pay back to my home equity line of credit. Or I'm gonna use my credit card to pay the policy, and then that goes out and invests, and then it comes back and eventually pays my credit card, but I just keep using it. In fact, maybe I won't even pay my credit card back. I'm just gonna tell you, that is a bad strategy as well. Now, can it work? Yeah, so. It's definitely not the optimal way to use this. Why? Because the thing that's kind of the half-truth that's taught out there by a lot of people in the infinite banking space, they'll say, oh, well, you just pay yourself back the interest. So you're really not paying any interest. You're just paying yourself interest. That is false, guys. The truth is this, is that you are borrowing money from the insurance company. Now, before some of you are like, why would I why would I pay money or pay interest for my own money? Why would I borrow my own cash? Hold on here, Sparky. You're not actually borrowing the money here, okay? I mean, you're not borrowing from yourself. Your money's still over here. You don't touch it. What happens is that the insurance company, they'll say, listen, I know this money's safe over here. You've got it locked, we're gonna lock it up while I give you whatever cash it is. So I'll lock up whatever cash you have and I will give that money to you over here. We'll lend you the money and we will charge you interest. They do charge you interest. You're not paying yourself interest, you're paying them interest. But here's where the half-truth comes in. You're earning compounding tax-free interest on the full amount of money. So for example, say you have $100,000 in here, you wanna borrow $50,000, you don't take it out of your cash. You borrow $50,000 from them. You pay the interest back to them, but that full $100,000 is making interest, which can actually exceed what you're paying them. That's how you're able to double dip, make money in two places at the same time. So when people say, I want to borrow money from a credit card or home equity line of credit to pay these premiums, now you're paying interest twice. You're not earning interest twice, you're paying interest twice because you're now paying interest to that credit card or to that home equity line of credit, and they're then taking it through, you're paying insurance costs as well, so not all of it's going into your policy, and then that money is going to pay an interest to them. When you borrow from them, you're now paying interest to them. So now you're paying interest to two different lenders, and then you're investing the money. So it kind of just dissolves the return that you make. You'd be just better off, this is what I would do instead. If you're looking at taking your home equity line of credit and investing it, here's what I would rather do. I'd rather have you still use your own cash to pay your premiums, but then take that home equity line of credit and go and invest it and use that money. Don't put it in the stock market. That's illegal, by the way. You can't do that. Don't go buy mutual funds. I'm talking about like using that to go do like real estate investments, like in real assets, cash flowing assets ideally, so you can at least pay for your monthly payment and then some, right? And so just pay directly from the HELOC, use that money to directly go into the investment. Yeah, but Chris, I want to double dip. I want to go through the policy. You don't need to do that. You just go and invest it, and then the returns you make beyond what it costs you to be able to pay back the mortgage, great. You can put that extra back into your policy or do another policy or something like that. But don't get caught in the trap of borrowing money to be able to do that. I think, again, that's just another ploy for insurance agents to make more commission, to find more money for you to use. Don't do that way. Make more money over here, and then that can help fund your policy. Now, many people will talk about using this in place of getting an auto loan or a mortgage. In most market cycles, especially in recent history, don't you dare do that, okay? You can get cheap auto loans from banks still right around the 6% range. There's still mortgages right around the same place, right? I still love leveraging the bank's money, especially when it's cheap money. 6 or 7% is still relatively pretty dang cheap. I mean, I remember when I was a mortgage broker 15, almost 20 years ago, and you know what? I remember when rates were a cheap rate was right around 6%. I was quoting 6%. I remember I was a rock star when I was able to get my rate all the way down to 3.875. I was like, I don't know anybody's got a cheaper rate than me. Well, nowadays, he's like, if you got 3.875, it's like, oh, what'd you do wrong? Do you have bad credit? Right? So anyways, I like getting cheap money from banks, and then I leverage my policy instead for getting things that I can't borrow money for, or for things that might be really extra expensive that I might have to use a credit card for. Because the truth is, like I said, you're still paying interest to them as the bank. So it's crazy when people say, well, I've got a 3% auto loan, but I want to go ahead and get a 5% or 6% loan from the life insurance company to go pay that auto loan off. No, don't do that. Maybe it gives you warm and fuzzies because you don't have a monthly payment anymore, but you are paying more in interest than what you're paying to the auto loan company. And just so you know, the loans are the same. They're both simple interest. They're not compounding interest against you. Same thing with a mortgage. And by the way, the mortgages, a lot of times you can use that interest to even get a write-off depending on your situation. So don't use this. Don't buy into the fact of you're going to buy your cars or your mortgages unless if you're watching this video and let's just say the interest rates on those things go up to like at least 7 or 8% or more, then if the loan rates are still lower on the life insurance, then we might have a reason to discuss that. And that's where that idea came from originally. The interest rates were much higher when they taught that strategy, but it's just a strategy, not a general principle. So if the interest rates are getting really high in the banks, then we use this. Otherwise, leverage the bank money all you can get for cheap money. Now, this fifth and most important point is this. You want to make sure you do not set it up with high fees like what most people do. Most whole life insurance policies and most agents don't even know how to do what we're talking about here, where you get the best return possible. Either one, they don't know how to do it, which is most people. Most of them don't, a lot of them haven't even heard of infinite banking. But two, even if they know how to do it, I find that many insurance agents won't do it. Why? Because to get the best ROI in your policy, they have to cut their commissions to the lowest they can possibly go. And many insurance agents, because that's their career, won't do it. The reason we don't care is because we do passive income. We live what we preach. We talk about investing. We're investors first and foremost, and actually do infinite banking second. The crazy thing is we always get the best ROI on our infinite banking policies because we always try to go for the lowest fees we can possibly get. That allows your cash to grow faster, allowing you to get that double dip effect much better. And sometimes people say, well, I got an infinite banking policy. I'll give you an example. I had a couple that he was a dentist and they were putting in about $150,000 a year between their different policies. Well, I thought they would be fine because they had these policies for several years, and usually we don't recommend replacing those policies. But as we looked at it, we said, wait a minute, even though this guy's a well-known infinite banker, even though he's well-known in doing this in this industry, his fees are way too high in this insurance policy. In fact, if you actually did the same dollar for dollar money moving over, guess what happens? You'll actually have, in 20 years, you would have an extra $2.25 million more in our policy than theirs, even if you have to start over from brand new and you just do a tax-free transfer of that money over to this new policy. So needless to say, they moved their money over. They said, I would rather have that extra 2 million plus in 20 years. Thank you very much, especially if I don't have to pay any extra money out of pocket, right? And that's the thing, guys, is that you gotta be careful. It's hard to see what it is, but I'm gonna tell you that there are ways to make sure you get the best bang for your buck. And that's why we call one of our methods, not just max ROI, but no BS infinite banking, right? It's like, it just gives you the lowest fees every time, no exception. So anyways, guys, if you think this is great, keep checking out this next part of the series about what you should stop doing wrong.